Hi everyone, it's Grace. Welcome back to my channel. In last week's video, I shared with you what's going on in the Fed's brain when it comes to decisions about the Fed funds rate and the balance sheet. The Fed is facing a lot of very difficult decisions, and you need to understand what they're doing and why. You can click here to check out that video. So in today's video, we'll continue our discussion about the 2022 strategy about whether to buy, sell, or hold in Texas. I did one with Florida before, and trust me, you'll want to find out what's going on in the state. And also do a comparison between Texas and Florida. You can click here to check out that video. Before we begin, remember to subscribe to my channel and click on the bell button so you get notified immediately when new videos are uploaded. Also, feel free to give this video a thumbs up if you find it useful. The housing market has a lot of reaction to the treasury yield curve and mortgage rate, so I'll incorporate some of the most important macro policies into today's discussion as well. When analyzing the market movement, I sometimes find that a lot of factors can get tangled up, so it's hard to tell whether it's a seasonal effect or the effect of the mortgage rate hike, whether it's just a capital rush or it's the inflexible demand from buyers and renters. We need to look at all these factors individually so you'll have a precise understanding of your local market according to the policy. The first thing we're going to see is the map that tells you the current price as of February 2022. Red is the higher end and blue is the lower end. One thing you'll notice is that Florida's land mass is much smaller than Texas, so the metro areas are not as scattered as Texas. Even in metro areas, the entry price points are quite different. The highest price is Austin at $655K, followed by Dallas at $302K, San Antonio at $281K, Houston at $251K, Corpus Christi at $206K, El Paso at $184K, and Brownsville at $152K. In the Dallas area, the north are generally more expensive than the south. The Austin Round Rock area and some of its satellite cities are skyrocketing just in general. San Antonio area is also more expensive in the north than the south. The Houston area is mildly more expensive in the south than in the north, with a few places that are in the $400K, $500K tiers. I'm putting up the labels just for you to quickly eyeball the price in a map. Dallas, San Antonio, and Houston are all below $300K, while Austin is doubled at $600K, which is quite unusual. Most of the satellite towns around these four clusters are in $200K, $300K tiers, and then the rest of Texas are generally below $200K. That tells you the capital flow is really location specific in the Texas market. And then let's take a look at the year-over-year price growth, which is generally consistent with the price tiers, meaning that the higher the price, the higher the year-over-year growth. And this is quite different from Florida. You'll see a lot of mismatch in the Florida market. Some places have very high prices but very little growth, and other places have very affordable prices but very high growth. That's why it's super helpful to look at the price and growth trend side by side. Austin is almost the only area with growth above 40%, with the highest growth at 69% in Bear Creek, with a current price at $1.1 million. A year ago, it was only at $652K, so that was quite a price jump. And then let's take a look at the areas with above 40% and below 400K. Unfortunately, there are not many of them, and most of them are well above 400K and in the Austin area. But I'll point out a few that fall into the category. The first one is Kyle at a 52% year-over-year growth and a current price at $389K. And the second one is Utland at 48% year-over-year growth and $381K. The third one is Gerald at 50% year-over-year growth and a current price at $351K. The next one is Taylor, also at 50% year-over-year growth and a current price of $344K. The next one is Elgin at 46% and a current price of $323K. So all these 5 cities are in Austin. And next up we have Leroy at 52% year-over-year growth, so that's a very good price growth, at the current price at $272K. And then Ross at 44% year-over-year growth and a current price at $270K. And these 2 cities are in Waco, which is an area halfway between Austin and Dallas. And then we have Lozano at 42% year-over-year growth and just below 100K. The last one is Lego at 49% year-over-year growth and also a little bit below 100K. These 2 cities are in the Brownsville area. In the next part, we're going to add a third and fourth dimension into the discussion. We're going to look at the inventory change and a price cut change in some of the areas. And we're going to find out which areas are sensitive to the hiking mortgage rates and how sensitive they are. The Austin, Round Rock, and Georgetown area has a lot of volatility in its price cut pattern. I included data from January 2020 to this March to take a comprehensive look at what's going on in the market. Its price cut already started back in January 2020, but gets a lot of volatility during this time. The peak of the price cut is an average of 25K per listing in April and May 2021, and it dropped to 11K in January 2022. So there's definitely a seasonal effect here with the peak in early summer and bottom in the winter. The interesting thing is that in last January, the price cut was 10K and went up to 16K in February and 20K in March. While in 2022, the price cut is a little bit higher at 11K in January and goes up to 16K in February and 20K in March. So the increment of the price cut definitely felt some impact on the mortgage rate hike, which started last December from 3.05% for the 30-year fixed mortgage rate to 4.57% this March. And as of April 14th, it went up to 5%. So we can predict that if the mortgage rate continues to go higher, the price cut will also get steeper. At the same time, let's take a look at the inventory count. Its pattern basically matches with the price cut pattern, with peaks during the summer from April to August and bottoms during the winter in February. What's interesting is that the peak point in 2021 is basically the same as 2020 and slightly lower. In 2021, the inventory in February was at 5,400 and it increased to 7,100 in March. And in 2022, the inventory is at 5,400 in February and it goes up to 6,300 in March. So the inventory increase last year was even greater than this year. So it tells us that the price cut change is more sensitive to the hiking mortgage rates than the inventory change. With Austin's price year-over-year growing at 41%, what you'll see is a slower year-over-year growth trend as the price cut becomes greater. So in Austin, you'll see a seasonal dip up and a slower year-over-year growth. Currently, the price cut is about 3 to 5% of the market value, so the year-over-year growth from 22 to 23 will be 36% to 38%. Assuming that everything stays the same and the Fed doesn't issue an ultimatum like the Volcker crash. So here comes the tricky question. At the current moment as we speak, is it a good time to buy, sell, or simply just hold? That really depends on what your position is. I see a lot of capital rush in the market, but the problem is that there's a very high chance that Austin could be the next Bay Area. So the equity multiplier in the next 10 years could be tenfold or even more. There are just so many corporate headquarters relocating to this area. I mean, it's easier to move a household, but it's a hell of a lot more difficult to move like a factory or a headquarter. So based on this notion, it doesn't matter how the market behaves. It doesn't matter if it crashes or not. The important thing is that you stay there. If you want to get a share of the pie, this is the entry price you have to pay. If you move, someone else will come and take your place. So it makes more sense to hold. But let's say if you're a die-hard fan in Garfield, which is a town in the Austin area. You're like, I grew up here, I'm a local, I'm not going anywhere. I don't care if I have to get more loans. I don't care if the capital rush in or out. And I don't care if the market crashes or not. I just don't care. I'm sick and tired of being a renter and I want my own house. The only way they're gonna get me out of here is by carrying my body. That kind of diehard. Then it probably makes more sense to buy at a dip up. And this is the price cut high season, so you should buy. Of course, this is an extreme example, but you get my point. And a third situation is that you want to build equity quickly and cash out at the highest growth trend. Then obviously the market movement matters a lot. The 10-year treasury yield is moving up, and a fixed mortgage rate is also moving up, which will slow down the market and the price trend. Let's say if you put in 400K last year, and this year you're getting 600K, and you want to cash out a profit of 200K or use the money for something else, then it makes more sense to sell. I can show you what's going on in the market movement right now, but it's not my decision to tell you what to do. It's up to you to buy, hold, or sell. And then let's take a look at the Dallas, Fort Worth, and Arlington area. When we compare the price map and year-over-year growth trend side by side, we can see that both Fort Worth and Dallas are more expensive in the north and less expensive in the south. But when we look at the growth trend, in my opinion, Fort Worth performs better than Dallas in terms of the entry price point and year-over-year growth. In Fort Worth, The growth trend is roughly from 25% to 30% across the area regardless of their entry price points. For instance, Grapevine has an entry price point of $500K with a 25% growth, while Fort Worth has an entry price point of $301K and a growth rate of 29%. And a luxury market such as Southlake has a current market price at $1 million, also at 29% year-over-year growth. It's similar to some of the central and northern Florida markets where you'll find a lower entry price point and a higher year-over-year growth. This is a key tool in real estate investment because that's when you'll say, okay, this is a great return with lower entry price point. In Dallas, the pattern is a little bit different. In the Dallas area, the entry price point is $302K with a growth at 21%. And then let's go up north. In Plano, the price is at $501K at 33% year-over-year growth. In McKinney, the entry price point is at $507K with 39% growth. And in Frisco, the price is at $643K at 38% growth. So in order to generate greater returns, you'll have to pay more. And it feels like greater investment opportunities are limited to those who have more money. From an investment perspective, it's not really that ideal. But of course, this is not to say that all the cities in the Dallas area display this kind of pattern. In some of the southern and eastern areas, there are also cities with affordable entry price point and greater year-over-year returns. For instance, in Lancaster, the entry price point is at $263K with 27% year-over-year growth. In Seagoville, the entry price point is at $257K, also at 27%. And then let's take a look at the price cut situation in Greater Dallas. While the price cut follows the summer high and winter low pattern, it has been staying at the top at $10K level since last March. The only dip is at $9,100 last December and doesn't have any reaction to the mortgage rate hike. The higher price cut is actually an indicator of growth of housing price since the end of 2020. At the same time, let's take a look at the inventory count. Dallas is different from Austin because in Dallas, both inventory highs and lows dropped from 2020 to 2021, while the inventory highs and lows are pretty much the same for those 2 years in Austin. That tells us that the greater Dallas area has more inflexible demand and lower capital rush when compared to Austin. And then let's take a look at the month-over-month inventory change. In last February, the inventory count was at 20K, and in March, it went up to 22K. This February, the inventory is at 14K, and it goes up to 16K. So the inventory change is greater at 13% this year than 8% last year, even though the actual number is lower. So this market is more sensitive to the mortgage rate hike than Austin. If the mortgage rate continues to go higher, we'll see a greater price cut and a greater dip up. So you should watch the mortgage rate very closely. The average price cut is around 5% of the market value, so you're mostly seeing an incremental slowdown of the price growth. If the growth rate is at 30% from 2021 to 22, it'll be approximately 25% from 2022 to 23. The inventory doesn't seem to be picking up, and people also don't have much motivation to sell. In my opinion, this market will be peaking as the mortgage rate continues to rise. If you want to find a new city to move to, Fort Worth or some part of Dallas might be a good idea, because the entry price point is good and the price will be soon capped at a certain level. You also don't have to carry a very high LTV, which is ideal for self-living homeowners. And then let's take a look at the Houston, the Woodlands, and Sugar Land area. The entry price point is more affordable than Dallas at $251K with 18% growth. It's a little bit like a sandwich structure when it comes to the price point. There are also cities to the northwest of Houston that are at $500K. Then to the south, Houston is at $251K, and then League City at $348K, and then Texas City and Hitchcock at $192K, and then Galveston at $342K. The general year-over-year price growth is around 20%, with coastal area a little bit higher at 29%. Then there's higher price point with higher growth. For instance, Pinehurst entry price point is at $511K with 40% growth, and the entry price point of Fulshire is at $580K at 25%, which is a little bit like Dallas. The price cut pattern of Houston is similar to Dallas. Greater price cut is a sign of value growth, and it stays at the top since March 2021. In last December, the price got dropped to 8K, and since then it goes back up to 10K. The inventory change is also similar to Dallas, with less inventory year-over-year growth and a seasonal pattern of summer high and winter low. From February to March 2021, the inventory increased from 26K to 28K. And from this February to March, the inventory increased slightly from 20,019 to 20,369 units. So the inventory picks up slower as the mortgage rate goes higher, which is the opposite of Dallas. It tells us that the inflexible demand in Houston is even higher than Dallas. So Houston is also a great place to move to with lower entry price point and not crazy price growth. Most importantly, I think inflexible demand will create price stability because it doesn't really fluctuate much according to the market highs and lows. It's also a great place for self-living home owners if you like warm weather. And then let's take a look at the San Antonio and New Braunfels area. The price pattern of this area looks a little bit like the top of a chocolate muffin. Some of the central areas are much more expensive than the rest, and the north is much more expensive than the south. Typical price in San Antonio is at $281K with an average of 25% growth. The growth pattern is that the closer to Austin, the higher the growth. The price cut trend in San Antonio is very interesting. In 2020, there is no change. The price cut remained at 5K. And then from March to August 2021, it went up from 5K to 10K. And then went back down to 5K from August to December. And then from January to February 2022, it goes up from 5K to 7K and goes back down again to 6K in March. So there's a little bit of a fluctuation here as mortgage rate goes up. Its inventory is also similar to Dallas and Houston. From February to March 2021, the inventory went up from 8,906 to 9,349. From February to March 2022, the inventory basically remains at the same level as 6,500 units. So the inventory doesn't pick up even as the mortgage rate goes higher. In fact, it becomes more popular as the mortgage rate goes up. So today we cover the metro areas in Texas in terms of their current market price, its year-over-year price growth, its inventory change, and price cut pattern. We looked at its year-over-year change, month-over-month change, and the seasonal pattern. You should understand that these areas act differently to the mortgage rate hike. For the areas that I didn't cover today, make sure to check out the maps and the line charts. I'll publish them on my website and my Tableau profile. So this is pretty much today's video, and I hope you find it useful. In the next video, we're going to take a look at the rental market in Texas and add a bonus tip to categorize these markets according to their investment values. So stay tuned. As always, thank you very much for watching, and I'll see you on the next one.